Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. It's October, and to quote Mark Twain, this is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. Love that quote. And it has been a little iffy here in October so far, with stocks are down about 7.5% from their July highs. So we'll see what happens through the rest of the year. Okay, on to this episode where we get to dig into one of the best commodity trading programs the past 2 years, talking with Jae-Min Hyun of NWOne, who surprisingly doesn't use a trend-following model, but instead a purely systematic strategy based on fundamental inputs. How does that work? Let's find out. Send it. This episode is brought to you by RCM's Managed Futures Group, who help investors identify and invest in programs like this one. Head over to rcmalts.com/podcast to see the write-up on this episode, or the RCM YouTube channel in this episode's description to find the link to the program's performance, and you can explore the rest of the RCM database. And now back to the show. All right, Jae-Min, how are you?
Not too bad, Jeff. How are you?
Good. Am I saying that correctly? I believe so, right?
Yes, sir.
And what's the etymology of the name there?
Well, it's a Korean name.
Okay.
It's meaning behind it, but I'm not going to bore your listeners.
Well, we want to know what is it?
It's actually meant to be. It's a Korean name. So obviously it's a Chinese character. I think J means. I think it's meant to mean leader.
Oh, perfect.
Spelled.
Apropos.
There you go. Thank you.
Yeah. And where are you? In New York, I believe, right?
Yes, but we're based in New York City, Midtown New York.
All right. You get any of that leftover, what was it, Ophelia? The storm leftovers?
Indeed, yeah, it's been a very wet weekend. Actually, right now it's raining outside.
And what's your take on New York? Is it back? Is it dying? Is it fine?
No, I think New York is pretty much back. It's tough to get reservations at various different restaurants and various different events. So yes, absolutely, New York is back.
Love it. And we're New York and Chicago. I can't tell if that's a siren here in Chicago or in New York.
It must be New York.
We got them here all the time too. So let's start. Tell us a little bit about your background. Had some options trading back in the day. So yeah, let us know where you came from.
Yes, well, me as a person, I'm Korean. I spent considerable amount of time in the UK, some time in Indonesia. I had a very brief stint in France, and I've been in the US for close to 12 years now. So that's my personal background.
Yeah.
In terms of my professional background, I started my career in Morgan Stanley in London, and I was transferred to New York 12 years ago. After leaving Morgan Stanley, I went to work for a couple of different hedge funds. Ellington Management was my first place, and then I worked at Tudor's Launchpad Trading before setting up my own company, NWOne.
And so what were you doing at Morgan Stanley? Or I'll go back even before that. Where were you in Indonesia? And what were you doing there?
Indonesia, that was like when my family moved to Indonesia when I was 8 years old. It's my dad's business, so we moved there. But I schooled in the United Kingdom.
Got it. Where did you go to school? Eton?
No, I went to St. Paul's.
I just know it all from that's my that pops up in the crossword every now and then.
I'm sure it does.
So Morgan Stanley, what were you doing there? You got your first taste of commodities?
Yes, so I did started off doing a bunch of different things: convertible bond origination, interest rate derivative structuring, equity exotic structuring. But I ended up on the commodities trading desk. So I spent the vast majority of my time trading commodities, Morgan Stanley, between London and New York.
And were you kind of banished to the commodities desk, or was that a good place to be? Was it a coveted spot or no?
Indeed, yes. Morgan Stanley, I would say, back in 2000s, top two commodity trading houses on the street, between Morgan Stanley and Goldman, as you know. Morgan Stanley, we were more involved in physical commodities, whereas Goldman's, they're much more the paper side with their indices. But yeah, Morgan Stanley was a major player in commodities trading.
And so what did that look like? You were helping facilitate moving oil tankers and rail cars full of grain, all that good stuff?
Yes, sir. Yeah, absolutely.
Uh,
So
yeah,
dominant
go
in
ahead.
physical trading.
Say again.
We're dominant in physical trading.
And so I've always thought, was that easy to be on the trade desk if you have the physical to back it up, right? If you're wrong, you can take delivery or vice versa. Did it make it a little bit easier?
At firm level, yes, but obviously,
Yeah, they'd
I
still count
trade.
it against your P&L. Yeah.
Yeah, I trade paper, but I sat across from physical traders. So yes, I did learn a lot of ins and outs of physical trading. And also market color was helpful. But again, strictly, we all had our own books.
And
But
then when you say trading paper, you mean futures?
yes, features and options.
Right. That those are fighting words here in Chicago. Can't call our beloved futures paper. Right?
Uh,
Um, so then moved out of there and went to what was the name of the hedge fund?
Ellington Management.
Ellington. All right. What were you doing there?
So I was hired as a quant portfolio manager at Ellington. Ellington, predominantly a fixed income derivative house.
Mm-hmm.
Just set up a quant global macro fund. So I was hired as a commodity specialist for that fund.
And all pure quant.
Yes, systematic.
And even backing up to Morgan Stanley, were you pure quant then, or you were learning the ropes and figured quant was more where you wanted to be?
No, in Morgan Stanley, we're all discretionary traders, right? So there were um, pure systematic traders on the prop side of things as well as on the agency side of things, but we are on the principal desks. So we are discretionary traders. So we are market making for big institutional flows. So we're all discretionary traders. At Ellington Management was where I first learned the ropes of doing systematic trading.
And what was your first foray there? Were you kind of a trend following model, as most newcomers to quant do?
No, I mean, you obviously study various different strategies that are popular. So I did study trend, mean reversion, carry type strategies when I was at Ellington. But I focused mostly on what I knew, which is bottom up fundamentals trading and commodities. So my role at Ellington was to systematize a lot of the alphas that I traded and I knew at Morgan Stanley.
Love it. And then you finally said, "Hey, I'm going to go hang my own shingle, so to speak.
Yeah.
Start out on my own." How was that? Nerve-wracking?
Oh, absolutely. Absolutely. Yeah, not an easy journey, by all means. Um, but it has been rewarding.
And how do you think about that even now as you hire your own people, right? Like, does it make you to those funds, they fear obviously you're going to go leave and start your own thing, but they also must support it and they want to train you well enough and teach you enough that you could go do it on your own, right? So like how do these firms strike that balance of like we want to teach you everything we know, but we're also don't want you necessarily to leave, but we probably know some percent of all of you are going to leave.
Yeah. So that was the initiative behind, launchpad trading, right? So this is
Mm-hmm.
I went after Ellington Management. The objective was to identify next set of star traders, given the infrastructure and capital and support to make them into qualified money managers, right?
Right.
So, yes, there are various different institutions, places out there that nurture um, relatively young traders, right? But those seem to be very few and far in between these days.
Yeah. Harder and harder. It's when and what the conversation now probably starts with how well can you code, how well can you do computerized things versus not. And then I buried a little. So what was your education? Were you a quant by trade in your schooling?
Yes, so I studied physics at Cambridge, in bachelor's and master's. So I did have a natural inclination to model things, right? Processes, a lot of
Mm-hmm.
using mathematical models. So that obviously helped um, when formulating systematic strategies in commodities.
And do you feel the physics background, do you still, right? Do you think it's a solvable puzzle, or do you think it's always, right? It maybe some far string theory kind of astrophysics of like there's still unknowns and we just have to kind of do as best we can to get close to the answer.
Absolutely. Well, markets are always evolving, right? Physics, the physical world is relatively established, right?
Yeah.
So it is a function of getting the right models, ideas to fit, to come up with mathematical models and whatnot to fit the world. Whereas markets themselves are constantly evolving. So I think it's a different challenge, right? When trying to fit mathematical models to market behavior, human behavior. So there's most definitely different challenges involved.
Right. I think you see a lot of people come out of, I'll use science loosely, right? Or mathematics or science, and they come in and they think it's 100% solvable. And if they could just measure this, or if they could just measure that or get the right factor, they'd solve the machine and be able to print money and all that stuff. But sounds like you're saying not quite that easy.
No, I don't think it is. I mean, certain areas of I think trading, there are closer linkages, I would say. So if you talk about startup trading, equity long short startup trading, statistical arbitrage trading, I think you probably see more of those PhD types.
Mm-hmm.
But most definitely not in commodities because commodities require domain knowledge, right? So
Mm-hmm.
commodities, and they don't teach you that, in schools, right?
Right. There's a great book, old book, The Predictors. It's about they were out in Santa Fe. I'm gonna forget the name of the firm, but they basically a bunch of PhDs and they left and tried to model all this. And there's chapters about how they didn't realize there was slippage and they didn't realize commission costs and exchange, right? So there's just the lessons they had to learn to get their models close to what they thought they could do were enormous
Yeah.
back in the 70s. We'll put a link to that in the show notes if I can remember. Um, so anything else we need to know? The background, where'd you come up with the NWOne name?
Oh yeah. It's named after a postcode in London,
Hmm,
which is where I used to live. So I was inspired by my former boss, Mike Varenos, Ellington, who named Ellington after where he grew up. So it's a kind of a, homage to Mike.
I love it. I didn't even know how postal codes work there. So NW1, that sounds fancy. It sounds right in the middle. First
Uh,
postcode.
that's right, Northwest one. So it's very close to, well, it includes Regent's Park, which is where I used to live, opposite Regent's Park, which is where I used to live before I came to New York.
Got it. And how long you been in New York?
New York, 12 years.
12 years. And how long's NW1 been up and running?
We've been up and running 6.5 years.
Six and a half. So what do you think? What are some of the best parts about running your own firm versus working at a hedge fund and some of the worst parts?
Um, I would say working at obviously having your own company uh, enables you to make decisions that are purely based on your own thinking, right? So you don't
Mm-hmm.
listen to many people. So, but with that flexibility comes more responsibility, right? But again, I worked at different institutions, big institutions, small institutions, and I when I started the business, I thought I had a pretty good idea of what a perfect institution should be, and I'm striving to achieve that. Working at pods, other places, has its own challenges, right? On the upside, you're given a lot of resources. On the downside, um, capital obviously is relatively competitive at those shops, and they have very strict risk limits that sometimes move as a function of the market or as a function
Mm.
of what's doing. So those are the challenges which prompted me to leave that space and start my own shop.
But funny enough, it wasn't like you were, well, I don't know what you were like at the shops, but it wasn't like you needed to be more risky, right? You're not very risky now. So,
No, and the objective function is maximizing risk adjusted returns. So
right.
you're not in the business of swinging for fences. No.
So let's dive into the strategy a bit. For those of you who want to go download our rankings white paper, and this has been up there amongst the best over the last couple of years. So let's just start with kind of a 30,000 foot view, what you're trying to accomplish, what the strategy does, and then we'll dig in from there.
Yeah. So our programmed objective is to extract alphas or inefficiencies from commodity markets that are based on individual commodity market fundamentals, right? So we mostly focus on market fundamentals as opposed to technical factors or heuristics that a lot of our competitors that specialize in systematic strategies do. So that's our biggest differentiator compared to competitors. Um,
And
and
pure commodity too, right?
yeah, we only trade commodities.
So pure systematic commodity. And then that was interesting to hear you say that. So do you view alphas and inefficiencies interchangeably? Are those the same thing to you?
Yes,
But that implies that you have to be able to capture the inefficiency, right? Or profit from it.
absolutely, yes. And again, there are alphas or inefficiencies that are present in the market that you may not be able to capture using systematic frameworks, right?
Hmm.
So that's the way I see it.
So pure commodities, how many, what are we talking? The global list, the most liquid commodities, how many commodities are we talking?
Yes, we trade up to 20 different commodities. We trade in terms of instruments, we trade outright futures into commodity spreads, calendar spreads. So we're relatively varied in terms of exposure across 6 different commodity sectors.
So
And
all the usual suspects there, oil, grains.
yeah, softs, meats, precious metals, base metals. For base metals, we do not trade LME. I
Do not
personally,
trade LME.
no, I've not traded LME contract since leaving Morgan Stanley.
Was that so that wasn't a result of their nickel debacle
No, it's just that,
where they reneged on all the trades?
obviously in retrospect, I think it was the right thing to do, but LME contracts are relatively expensive to trade as far as I'm concerned, because you have to trade it 3 months and then roll to the nearest futures lookalike. So in principle, you end up paying transaction cost twice. Um, and that was relatively frustrating for me. So for those reasons, I decided not to trade LME contracts in our program.
Got it. And so those parts again, so you have um directional future strategy. And what was the other one? Intercommodity spreads.
Oh yeah, into commodity spreads. Again, that's part of the directional strategy. So
So
go long.
that I could be long coffee and short cocoa, something like that.
Yes, in principle, yes.
Um, okay. Uh, and then we spoke before. The future strategy is shorter term.
The outright future strategy, it is short term in terms of holding period. There's a holding period around 1 week. And the calendar spread strategy that has a longer holding period, between 1 to 8 weeks. And our last intraday strategy that trades outright futures, and that has a holding period between half an hour to 1 hour.
Hmm. So let's go through those in order. So the future strategy directional holds up to a week. How it's not trend following, it's not mean reversion, it's something in between, something different? So how are you generating, without giving away the secret sauce, how are you generating those signals? What are you looking at there?
Yeah, so for the outright feature strategy and the counter spread strategy, and to a certain degree the intraday strategy, they're driven by right now 9 different classes of models, right? So each class of model, the objective is to identify orthogonal sets of inefficiencies or alphas in the market, and the idea is to build collectively an exhaustive way of extracting alpha, where the individual model classes are orthogonal from each other.
Mm-hmm.
So within those 9 different classes, we have different ways of identifying sets of inefficiencies. Could be anything between pure fundamental data set, could be seasonal risk premium, could be related to the lag relationships between various different variables and asset prices. Some of it could be based on market positioning of either speculators or consumers, all those fun type of stuff.
Is an easy way to think about that I know the price of production for oil is $76 and we're trading at $86 or something, right? That relationship between that fundamental piece of data and the market price.
Yeah, that is a component, yes. So we do look at the S&D dynamics for various different commodities where the data is available. We will then run various different statistical tests against those variables and changes in either flat price, calendar spreads, or intercommodity spreads. And for that specific set of, say, fundamental data set, if it has a high forecasting power for calendar spreads, then it will be considered for inclusion in the final portfolio. But we obviously go through a rigorous in-sample, out-of-sample testing, and after that, we have a period of paper trading before anything can be even considered to be included in the final portfolio.
And it's the whole idea there's you're using those fundamental factors to kind of assign a value price for the commodity. And then if you're below that, you'll buy. If you're above that, you'll sell.
Yes and no. So in terms of our model outputs, we focus on continuous outputs, right? So we never have a single step function type model output. So all our models generate a continuous spectrum, -1, most bearish, +1, most bullish.
Got it. And everywhere in between.
Everywhere in between. And then by having continuous distribution, it's much easier to combine different signal sets and to minimize any data mining, right? For example, imagine if you have a step function, you could always tweak your threshold narrative or fit the most recent historical data, but we avoid that by using continuous spectrum.
That's interesting. So across all those models, we'll stick with oil, or we'll get off oil because we're going to talk about that next. But cotton, you trade cotton?
Yeah, it's a challenging market.
Yeah. So we'll talk cotton. So model 1 is saying 26% long or something like that.
Yeah.
Model 2 is saying 16% short. Model 3 is saying, and then you'll get the net of all those and say, okay, we want to be 32% long.
Absolutely, yes. So we apply a different weighting function across this from different model outputs. And then the resulting aggregate of those individual model outputs will be applied to either cotton flat price, calendar spreads. We don't do intercommodity spreads in cotton.
Got it. Yeah. But the idea there is not that, so you're not necessarily saying cotton's underpriced versus its real value, we want it to go up. You're just saying over the next week, we think it's going to go, the aggregate of the models believe the price is going to rise based on those factors. We don't care why. We
do care. Individual models will have their own reasons to say why it should be going up, right? For example, one of the models could be based on fundamentals. Let's say, okay, fine, in terms of S&D balances, based on the latest USDA balances, the model is bullish. calling spreads. On the flip side, it may say, the currency dynamics between US dollars versus various different other foreign currencies may dictate bearish, right?
I like that. So that's the directional futures. And then it could be, in theory, could it be 100% long, right? One on all of those? Or there's limits within each sector and within each market?
Yeah, there are limits. So at the individual model level, we'll produce model signal from -1 to +1.
Okay.
Those will then get aggregated based on our proprietary algorithm, and they will then get passed through to our portfolio construction engine. So at the portfolio construction engine, we place constraints, right? So we have constraints at various different levels. So one of the constraints we have is at the sector level. Let's say no single sector can take up more than 50% of the portfolio risk. And within the sector, no single commodity can take up more than 50% of the risk. That ensures our portfolio is diversified at any given time, right? Because we trade across up to 20 different commodities, we rely on diversification, right? So therefore, our portfolio has to be diversified in terms of exposure at any given time.
And what would you say some trend followers that trade 120 markets would say that's not enough diversification. Only 20 markets isn't enough. Of course, there are a lot of those that they're mentioning were probably fixed income and currencies and bonds. But what's your view on how many markets is enough versus diminishing returns of adding more markets? How do you view that?
Yeah. All right. Trend followers, what they're trying to do is they're trying to extract this unique set of alphas, right, that stem from either cognitive biases in the individual market participants or inefficiencies in information transmission mechanism, right?
Mm-hmm.
What they're trying to do is they're trying to extract that small piece of alpha, right, that are present in every single market. And the only way you can consistently do that is by deploying this strategy across many, many different markets, right? So they need diversification to extract a relatively small amount of alpha that's present in each of the markets, right? Whereas our approach is quite different, right? So we don't look for top-down heuristics-based alphas. We study the individual markets, right? Say, okay, what are the fundamental drivers of crude oil, of corn, soya, right? So we build understanding around the individual commodity market, fit relevant models, rigorously test them, and then we build portfolio from bottom up. So our portfolio is very much bottom up. Therefore, by construction, you can say that our exposures are less correlated, right?
Mm-hmm.
Because in trend following, we've seen this many times, right? If the trend breaks in one segment of the market, that tends to translate to the other segments of markets, right? Because people unwind certain set of strategies as a knock-on effect. Whereas for us, we treat the individual market as his own thing. Do we get affected by some of these flows from trend followers? Of course we do. But again, the way we construct our portfolios and to be robust enough to withstand any of those flows.
Is that an input even? Is that one of the data pieces in a way of those flows?
Yeah, I mean, we do monitor flows. We monitor flows of speculative community as well as hedging community. And we have models that contribute signals from those types of alphas or inefficiencies.
So it's the futures. Next was what? Calendar spreads or inter-commodity spreads? Or you use those interchangeably?
The calendar spreads. So inter-commodity spreads falls into the bucket of outright futures trading.
Okay, you're basically just creating a new futures market?
Yes.
Yeah. All right. What's some of and will that get really crazy, or there has to be some link? It has to be soybean and bean meal, or oil and nat gas. You wouldn't do something totally crazy.
No, we only look at pairs or spreads that are actively traded by, say, hedgers.
Okay, got it. So
It's
it's like a logical fundamental link as well as a quantitative link.
correct, yeah.
Okay, so then the calendar spreads, what's going on with those?
Yeah, calendar spreads is obviously interdelivery exposure across different commodities. And one nice thing about calendar spreads is that you're hedged from currency exposure point of view, right? So if you go
Hmm.
long outright, say, cotton contract to long cotton, then you're short US dollars, right? Whereas in calendar spreads, if you have the long and short across different parts of the curve,
The whole thing will move up or down.
yeah, mostly. So that's a nice characteristic of calendar spreads. And also, calendar spreads obviously are linked to storage dynamics for various different commodities. And storage obviously is mostly driven by fundamentals. So trading calendar spreads is a pure way of expressing or extracting any alphas that are related to fundamentals.
And do you view that as trying to earn a yield, sort of like almost like a carry strategy?
No, not necessarily. I mean, there are certain spreads that exhibit, either positive or negative beta, right? I
Hmm.
think that's whichever way you want to express it. But our goal is not to extract those sets of premiums. If it's there, fine, we will extract it. But our goal is not to exclusively extract those sets of premiums.
It'd be more of, hey, based on these fundamental factors that we've brought in as data, we think it's going to steepen or it's going to flatten.
Correct. Yes.
Um, do you ever get curious and run that on bonds just to see where we're going to go, where the yield curve's going to go?
No, unfortunately not. I try to focus on the things that I know.
Exactly.
That
Yeah.
are re-
And so the futures was days to weeks, the calendar spreads weeks to months. That makes sense.
Yeah, up
Weeks.
to 8 weeks in a couple of months. And as calendar spreads exhibit lower dollar volatility. So therefore, you have to have relatively long holding period to justify transaction costs as well as the volatility of those contracts.
But in the past, some people have been right, kind of a widowmaker trade too, right? Because it has such low volatility until it doesn't, until the
Absolutely.
spread totally, who are the nat gas guys famously, but Amaranth. So how do you avoid that of like, okay, I know it's a low volatility trade, I'm going to hold it months, but it has the ability to get totally out of whack, right? Hurricane Katrina, those all the production was shut in down in New Orleans. So there's outside events that can make those spreads go pretty crazy.
Yeah, I mean, that's a definite concern. So we mitigate that by number one, using relatively conservative estimates for volatility for sizing trades. And number two, we're commodity specialists, right? So we are
Hmm.
aware of those sets of spreads that can blow out or have
Hmm.
asymmetric risk reward profiles. And we position our strategies or trades to be on the long convexity side of things, right? So those spreads you talk about, a lot of these black gas spreads, especially some gasoline spreads, some of the seasonal spec changes, um, they have it's like being long carry, right?
Yeah, where it's like a negative skew, right? I'm collecting until
And
not.
yeah, so we tend to build a portfolio to avoid those. We want to build a portfolio of convex expected returns, right? Positively skewed. So often, we take the other side of that. So often, some of our positions end up paying away a small amount of decay with expected relatively big returns.
And so we have a lot of long volatility people on this pod. Do you view it as kind of a long volatility program? Is it going to, do you believe it'll do better in a 08, or March of 2020, those kind of periods when volatility is spiking?
That's kind of difficult to say because we don't construct our portfolio or our signals uh, with those specific characteristics in mind, right?
Mm-hmm.
So by construction, we try to be agnostic. Uh, but do we do better in those volatile periods of high elevated levels of macro volatility? Probably not, because our strategies and our models are based on individual market fundamentals, right? So we need an environment where the individual market fundamentals can play out. If there's an elevated amount of macro noise, then our signal to noise ratio for each model is expected to be lower, right?
Right.
You cannot expect our portfolio to perform, when all hell's breaking loose, right? But then
Right.
you have long vol players out there, you have trend followers who are supposed to take advantage of those market conditions, right? So we don't aim to offer we don't aim to be like
Yeah.
your
But it
limit.
was interesting to hear you say you are cognizant of, well, we're not putting on, at least in the spread trades, right? These huge negative skew, negative convexity trades. Um, but yeah, it makes me think of back during COVID, right? And they're on the news saying we've never seen the meat market like this, and we have to kill all, cull this herd and do all this stuff. So if that kind of talk is going on, it's generally not fitting with your models, right? Because it's outside the norm.
Yeah, that's right. COVID wasn't particularly friendly for us. Huge demand destruction across all commodities, right? So those kind of idiosyncratic events that have an overwhelming effect across all different markets, you can't expect us to perform because we haven't designed our portfolio or our strategies with those events in mind.
Right. But your risk control, you're not going to blow up in those type of events. You're just going to mainly be on the sideline or be
Precisely.
lower conviction. Right. And then the most interesting piece of these three to me, at least, is this intraday oil trade. So what's going on there? Even though you said you can't tell me too much about it, we'll try and pull something out of you.
Yeah. So the intraday trading in oil, the idea is to model behavior of physical traders who are active during certain periods in the day.
Okay.
Our objective is to trade around them, right? So we anticipate what the physical hedgers are going to do, and we trade around them.
So fair to say flow based, for lack of a better word, or demand buy side based, something like that.
Yeah, it's flow that are derived from hedgers. Um, and as you know, hedgers, they tend to be less price sensitive, right?
Yeah.
So
And who
they,
are we talking about there? Like airlines and uh manufacturers, whatever, any bona fide oil hedger, or even the majors who are trading in and out on both sides.
oh yeah, everybody.
Okay. So not just hedgers, but well, they're hedging on both sides. Got it. I was thinking just the long side. Yeah. Um, great. All right. So then those three are always working in concert. Is there a set budget, like a third of capital to each, or they're just each model's independent, bottom up, you're saying, with the risk controls on top?
Yeah, so we do try to limit risk exposures across different strategies, right? So each strategy, the three strategies, the outright futures, calendar spreads, and intraday strategies, they're always competing for risk capital, right? So we do a monthly review of risk allocation across the different strategies. But again, similar risk management framework is in place. So no single strategy can take up majority of the risk capital. Majority in the strategy level sense is 60%. So no single strategy is expected to take up more than 60% of risk capital at the portfolio level. So that ensures that where in terms of our exposure at any given time for different groups of alphas is diversified.
And so the 50% max sector and market inside each strategy sleeve, and then each strategy sleeve is 60% max
No, the sector exposure that's done on the
portfolio.
portfolio level, yes.
Okay. Right, because then you could have 50 of 60, 30, 30, 30. You could have 90 in one market if you did it my way. Stick with your way.
Mhm.
And so that is quite unique. And why just in oil for that intraday trade?
Um,
Do you do any other markets or no? For now, it's just in oil.
that was just oil. There's a phenomenon in oil that's driven by fundamentals um, that induces hedges to behave in a certain way. That's why it's currently only trades oil markets, but we are always researching different markets for intraday strategies.
And let's touch on that for a second, just what your whole research process looks like. How long it took you to get to where you are now, what this might look like in 2 years will be the exact same or always progressing. What's the research side look like?
Yeah, so we're always progressing. The 9 different class of models that are currently live. I began with one class of models, right? We've added on many, many models. We've retired many models. The research process is always ongoing, but it's always incremental, right? You can't expect us to make any big changes because we need enough out of sample data to justify model inclusion or model retirement. So you'd expect the makeup of our models to expand overall as we have more resources to deploy, as there are more data sets, as the market evolves, we'll be adding on more and more models, more strategies. At the same time, we'll continue to retire any strategies or models that are not working because markets have structurally changed. So yeah, it's an ongoing process.
And back to that other question of the 20 markets, is there some limiting factors or point of diminishing returns? Right? Could you eventually have 500 models, 5,000 models?
Yeah, absolutely. There is the element of diminishing returns, right? Because there's so much inefficiencies out there, right?
Yeah.
So the inefficiencies, obviously, we try to extract using different models, often could be overlapping to a degree. So if that's the case, then we'll look to enter new markets, right? So we'd love to be able to trade Chinese commodities, onshore and offshore, QFI commodities. That's in the cards. Also like to be able to trade FX contracts and also interest rate contracts. But that's, much, much further down the line.
Love it. I know a guy who can help you get into China. Zooming back out a little bit, we touched on a lot of this, but I just want to follow up with the why commodities question, right? Why, and touches on, you want to get into interest rates, you want to get into that stuff, but why is it just commodities for now?
Well, number one, my background has been in commodities trading
Mm-hmm.
back to mid 2000s. But another interesting aspect of commodity markets is that you have this one group of market participants, right? Namely hedgers, who are willing to pay away hedging premium to the market, right? So you have a large group of participants that are paying away hedging premium to the market. Now, from speculators' point of view, if you have relatively good models to model the price process, model the fundamentals, you can pick up those hedging premiums that are being paid away by producers and consumers, right? Well, that's a unique aspect. So I'd rather participate in a market where a group of participants are willing to pay away X amount of value to the market, right? As opposed to having to fight with other like-minded speculators for relatively limited amount of inefficiency available in the market, right? So
Right.
I think that's why I think commodities market is pretty unique from that point of view. but also commodity markets relatively inefficient compared to other markets, right? Because if you talk about commodities, you can talk about different grades of commodities. Number one. Number two, where geographical attributes associated with commodities, right? Is it soybeans grown in the US? Is it Brazil, right? So it's not just like one single asset talking about.
Mm-hmm.
It's in the spectrum. So that leads to more inefficiencies in the market that can be extracted, right, if you're an informed speculator. So this is why I like trading commodities.
I love it. Hey, you're preaching to the choir. And how do you view, right, the traders at the big commodity houses who have billions of dollars? They have the same ideas, they have the same thoughts, and they have way more money. So how do you view that kind of competition of, right, why don't they do what you do?
Yeah, it's a very good question, actually. So some of these big commodity trading houses, their primary business is in physical commodities, right? So
Yeah.
it's transporting these physical commodities from region A to region B, storing those commodities, and then obviously hedging those exposures, selling them ahead. So they're pretty much involved in trading physical commodities, and they use paper/futures market to hedge their positions, right? And we are exclusively focused in trading futures. So, in fact, a lot of the activity, a lot of these trading activities that are done by physical commodity trading houses are useful for us, right? We use the information, the hedging activity of these physical traders to infer, to augment the current fundamental market state for various different commodities, right? So I don't particularly view them as competitors per se, right? They play a very important role, obviously, in the global trade flows. And if anything, their hedging activity tells us more about the current fundamental market state. And as to why are they not involved in trading futures in the way that we do? I'm sure they do. But, I'll give you an example of, a car company, for example, right? So, why is Mercedes not involved in running taxi business or Uber, for example, right?
Mm-hmm.
Their primary focus is physical commodities, right? And our primary focus is futures trading. Obviously, there are areas that overlap. For the most part, they stick to what they know, and we stick to what we know. But ultimately, sure, in 10, 15 years' time, right, there will be some sort of vertical integration, right? Or the car industry, that's what Elon Musk is trying to do, right? He's trying to integrate, have cars running around. In commodity markets, maybe in the near future, that will come.
That breaks my brain thinking about that. If you were inside one of these big places and had all their information in their flow and were trading against it, right, would it basically eliminate the inefficiency? Because then their other side of the business would be like, oh, Jae-Min's telling us we're overpaying here basically by his P&L, so we're gonna lower that side and your P&L is gonna come down. Right. So it's kind of hard to think about them existing in the same place because it would kind of cannibalize one or the other, would even each other out. But you'd think like a Citadel or some of these big firms would say, hey, and they do, right? They have commodity trading, they have oil trading. So I'm sure they're looking at much of the same similar stuff, but
yeah, most definitely. Citadel.
Yeah. But you've got your own flavor that does what it does. Just coming back to how do you view, right? If you started as discretionary on that Morgan Stanley desk and now totally systematic, are there ever times where you're like, oh, I don't want to put on that position. That doesn't make any sense. Or if I was discretionary, I'd do it separately. Like, how's that journey been of coming from a discretionary trader to a purely quant systematic?
Yeah, it's an ongoing journey, put it that way. So um, I think it's a journey that not many people take. Um, maybe for obvious reasons, but I've certainly been on it. It's been interesting, right? Are there times in which I wanted to override some of my signals? Absolutely. Have I done it before? Early in my career? Yes, I have. Um, but the beauty of systematic strategies is that you're looking for sets of signals or phenomenon that are repeatable, right? And are relatively persistent, right? Whereas if you're a discretionary trader, you look for you look for one-off relatively big opportunities that come by maybe 2 to 3 times a year, right? You're limited to that.
Right.
You're systematic, you're able to extract relatively, difficult to attain alphas, but because you're systematic, you do it in a systematic manner and you do it across many different strategies, you're able to extract those sets of alphas. So I think it's a much more sustainable way of extracting alphas from the market. But that is not to say, there are plenty of successful discretionary traders out there, right? But
Less and less these days, but yeah.
I much prefer this approach compared to uh, you know discretionary trading.
Right. And how do you view, right, the USDA report is notoriously error prone, lots of revisions. China's been known to manipulate their orders and whatnot to get better prices for themselves. Right. So you'd feel like a discretionary trader could better see through that bad data, so to speak. So
Yeah,
yeah, how do you view that of like, okay, I need to make sure this data is what I'm really seeing?
yeah. So what we do here is we augment, the pure fundamental data set with some of other market-derived signals, right?
Hmm.
So if those two are contradictory, ultimately aggregate model signals tend to be lower, right? Because fundamental model will say X and the market derived model will say Y, right? So our net exposure will be less. So we have strategies and models that mitigate some of those types of nuances you just described. But more often than not, these things are relatively short term in nature, right? So USDA, they may get it wrong, uh, 1 or 2 crop cycles, but overall they do a pretty good job.
One, right. But for a short-term trader, that could be all the difference in the world, 1 or 2 cycles.
That's true.
Um, but that just shows to me like it's hard, right? We can sit here and talk about, oh, we just throw in this fundamental data and get these price picture and can trade this stuff. But especially in commodities, that data is harder, right? It's harder to come by or no? Like, do you use any alt data sets like satellite imagery or things like that, or is it all rather standard stuff that comes out of Bloomberg?
Yeah, so we have studied some of the alternative data sets in the past, and there are many providers of alternative data sets. But because often, when we go through model formulation and model validation, some of these alternative data sets do not meet our standards. So we currently do not use any alternative data sets in production, but we keep track of many different alternative data out there. So for the models that are in production, we predominantly use data coming out from government agencies or well-recognized trade bodies.
And I'm come back one bit on commodities. So do you have a mandate to have commodity exposure? Like, would someone switch out their 5% long commodities at a institutional portfolio for your strategy? Or they're not necessarily going to get the commodity, they'll get the commodity exposure, but not the correlation to upside in commodities.
Yeah, our program, we don't have we don't have a long bias in the commodity markets. So if you're looking specifically for, price related inflation protection, you cannot expect that from our program, right? So our program is designed to extract inefficiencies or alphas that are driven by market fundamentals across different sets of commodities, right? So we are more absolute return focused as opposed to offering beta with respect to a given commodity market.
Got it. So throw it in your alt's absolute return bucket. And then as you've been on both sides of this, I wanted to ask the question of kind of how do you view, and coming back to your strategy design, the pros and cons of like, okay, I've developed 20 models, say, in-house that I'm implementing. They're non-correlated. I'm getting different alphas versus I'm a pod shop and I've hired 20 different alpha sources. So kind of, right, what are the pros and cons of hiring it versus building it?
Yeah, I mean, I can't speak much for pod shops because I've never. I mean, I sort of worked at a pod shop, but I can speak from fund of funds perspective, right?
Mm-hmm.
So you can conceivably replicate a lot of the alphas that we look for by hiring different sector specialists, right? So you can hire someone who specializes in oil, nat gas, grains, softs, metals, meats. But then by doing that, you effectively, it's a much more costly way of doing things, right? Because you have to pay, if you're talking about fund of funds, you've got to pay management fees and incentive fees to individual manager, right? And after that, you don't get any netting effects.
Yeah.
A group of traders may make money, another set of traders may lose money, right? But then you still have to pay fees, management fees regardless, but you have to pay incentive fees on the managers who make money, right? But you don't get any clawback from managers who lose money, right? So by trying to replicate by a diversified set of commodity alphas in the way that we do, by hiring discretionary traders, is a much, much more expensive way of doing things. Whereas for us, we deploy systematic strategies in place for discretionary traders, right? And we pass on all the netting effects to the investor, right?
Right.
So that is a very cost-efficient way of getting exposure to alphas that are related to individual commodity markets.
But how would you view, right? It's like a bet on, and I wasn't necessarily saying a pod shop trying to do exactly what you're doing, but just in general, like, right, I've, because you're kind of creating the same thing, all these different return drivers, right? An ensemble.
Yep.
And they're doing the same thing, creating an ensemble. They're not correlated. Let's generate the return. So it's kind of just the question of the hive brain versus your brain, right? Like it's all coming out of your brain and your research and your team, but versus each of those in theory comes not only with their own model, but their own way of thinking about it. And although I would suspect after being in there for a while, they kind of get some groupthink and approach problems the same way. But so I don't know if there's a question in there, but it's just interesting to me, right? Of the two paths of, hey, you can do this all with one brain, or you can do this all with kind of a galaxy brain of these different people.
Look, kind of leads on to a nice segue. We are expanding. It's not just going to be one brain race. We're actively recruiting multiple quant analysts or quant traders who are going to be value additive, right, to our organization. So I don't think it's about our approach versus their approach. I think the approach it's about dedicating resources to extract inefficiencies from the market, right? And
Right.
we are actively looking for more brain power for our team.
Which leads me into AI. So do you use AI to augment that already? And just being a physicist, being a quant, what's your views on the AI buzz recently?
Yeah, I mean, it's been fantastic, right? So the AI and machine learning investments into those areas have definitely been helpful for us. So we use all the architecture we use in-house is developed from the open source packages and tools available in the market. So has been very helpful to us. So in terms of using AI tools is less relevant for us because in AI, you typically need very, very large sets of data, right, to train your models, right, to formulate your models, formulate/train, and validate your models. Because we do bottom-up fundamentals-driven trading, so we treat each individual market as its own entity, right? There simply isn't enough data available for a given market to train a relatively sophisticated AI model, right? So those are the reasons that prevent us from fully adopting AI, but we are using tools that are machine learning based. We're actively using those tools for our research as well as portfolio generation.
But explain that for a minute, because corn goes back, right? I think there's 100 years of data on corn futures and whatnot. But you're saying there's not 100 years of USDA reports and some of the other fundamental data pieces?
Yeah. So this goes back to, question of why aren't other people doing what we do, right?
Yeah.
The typical, systematic strategies or systematic trading, as I mentioned earlier, you see it in long-short equities or startup, right? So in startup space, you typically trade, 2,000, 3,000 stocks on the long side and 3,000 stocks on the short side, right? So every day you have up to 3,000 data points, right?
Right.
3,000 long short, right? And if you were to backtest those strategies across many, many years, right? 10 years, there you have enough data point for you to formulate as well as validate any models that extract inefficiencies that are present in every single stocks, right? Whereas for us, we don't have that luxury, right? So we only get to observe, if it's end of day data, only one data point per commodity, right? So it's the challenge is, adopting some of these off-the-shelf models and frameworks into our space due to lack of data, right? So the way we get around that is by augmenting fundamental knowledge, right? So we can really zone in and say, okay, a lot of these feature sets or potential data points are not really relevant for determining the price process for a given commodity, right? Because I know, my employees know, because we study the market from the bottom up fundamentals point of view. So we're able to bridge the gap, and the gap that's missing due to lack of data points. Right?
Right.
So yeah, that's our philosophy, and that's the way we approach systematic trading in our space.
Right. That's a cool way to look at it. All right. I think we're about to leave it there. You got any other last bits for us? Anything we missed?
No, I think you covered pretty much everything.
Tell
Yeah.
everyone where they can find you. What's the website?
Website is www.nwone-llc.com. You can also reach us on LinkedIn.
All right.
Like I said earlier, we are actively looking to hire quant analysts, quant traders, quant researchers. So please get in touch with us.
Nice. Yeah. We've got a lot of young student level people who listen to this. So go give them a call. What does that market look like? Has it been tight? Are competing with a lot of other firms for that talent?
Yeah, I mean, there is a lot of competition. But the kind of people we look for are relatively different to what these pods look for. So yeah.
Yeah. Or versus like going to work at Google or Amazon or something too, right? Awesome. Well, thank you, Jae-Min. Thanks for being here, and best of luck moving forward. We'll come see you next time we're in New York.
Will do, sir. Thank you, Jeff.
Thank you.
Okay, that's it for the podcast. Thanks to Jae-Min. Thanks to RCM for sponsoring. Thanks to Jeff Berger for producing. We'll be back next week with, I don't know yet, but tune in to find out. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.